Welcome back to the Happy Hour Money Podcast. I'm your co-host, Isaiah Douglas. Josh Bennett also alongside again for today's conversation. Have a great guest today, and that is Eric Crittenden of Standpoint Asset Management. Eric is the Chief Investment Officer. And in full disclosure, Vincere, which is Josh and I's company, we actually do employ one of the Standpoint strategies. We are big fans. You'll kind of find out why here in a little bit. So what does Standpoint do? Reading a little bit from their website, they focus on bringing an all-weather portfolio solution to investors. And so I think the next natural question, and we're going to dive into this a lot more with Eric, is like, what's an all-weather approach? And we're going to get more into the weeds, but from the very high level, the most effective way to prepare for a wide range of market environments while still producing competitive returns with limited downside risk. That's kind of what all weather looks like. That's the way we would think about it. Eric, thank you so much for spending some time and coming on the show.
My pleasure. Thanks for having me.
And you're in sunny, cool Phoenix, Arizona today. And Eric, I know you've been on a ton of different podcasts and you've told your story and background. And what I wanted to do was take a little bit of a different approach, because there are some podcasts where you've gone really deep and really niche-y into some of the things that you've experienced over your career. And I will link to some of the favorites that I've enjoyed of yours over time for those that maybe want a little bit more detail. But I want to start with what I hear a lot from peers that are advisors that I respect, and then clients at times. And that is, okay, I'm a long-term investor. Why don't I just own stocks and bonds? It works. Look at these returns. What would you say to someone to like reframe that mindset, or why not just stocks and bonds?
Well, for me, it's simple risk reward. I like to think of myself as a student of history, particularly as it pertains to financial markets and returns. And I'm talking about going back, decades, centuries in some cases. And I can't ignore what I see. And I see long stretches where stock and bond portfolios would not have met people's needs, and in fact would have led to losses. The most recent example of that would be, when I was a kid in the 1970s, where, especially if you adjust for inflation, and now for the first time in my lifetime, post-adolescence, people are caring about inflation, but I always care about inflation. And if you look at the 1970s, there was a 14-year stretch where you had a 0% real rate of return with plenty of downside, 40-50% declines, lots of volatility, lots of uncertainty and fear. And knowing what I know, I just came up on my 24th year anniversary of being in financial services. So I've had a lot of experience with individual investors and financial advisors and hedge fund investors. Most people can't handle 14 years of going sideways with a lot of downside risk. Most business models can't survive that. And I don't see a lot of people preparing for such an eventuality. And it's not that hard to do. And from my perspective, it doesn't make sense to take that risk when it's completely uncompensated. A good all-weather portfolio that diversifies globally across many, many different asset classes has, in my opinion, been a great compounding vehicle for more decades than I've been alive. And historically, it's been able to thrive during some of the most hostile market conditions for stocks and bonds. So I look at it and say that's just a better way to invest if you're evaluating the reward you're getting for the risk you're taking and you care about those long flat periods. It just makes sense to me.
Yeah, absolutely. It doesn't have to be an all or nothing solution either. It can be like, and I can do that and this thing, and that complements each other well. And one of the things that I recall seeing in a presentation or a conversation that you did is also like the idea of the all-weather approach when you look at stocks and being in a bear market too, like this idea of how it can complement. So like the strategy that you'll run and others, and we'll dive into that here in a second. But I think that's an interesting take too, is you mentioned when it is the most painful, this actually comes through and says, hey, you're glad you own me now, right? Like, so it is that kind of beacon of light. And it has been, that way, year to date in 2022, where it's been kind of rocky for almost everything that most traditional investors owned. So can you give kind of a breakdown of, when you talk about like asset classes and across, like what does that actually look like? What does this kind of all-weather approach do? Like what's the focus of it?
It's a good topic because a lot of people lose sight of the fact that most of the asset classes that are easily and conveniently presented to them all share the same structural risk. So they'll be looking at things like stocks and bonds and REITs, gold, sometimes private equity, venture capital, long-short equity hedge funds. They think of these as asset classes and things to potentially invest into and diversify across. The problem that I've seen is that mathematically speaking, almost all of those have the same kind of trapdoor risk, where if GDP is going down and the economy is struggling, most of those asset classes struggle at the same time. So what you want, and to the point you were making a minute ago, having something that can stand up and deliver when you need it the most in hostile market conditions is incredibly valuable. It's also rare. It's not small. It's just there's only a couple of asset classes that historically have been reliable when in hostile market conditions. And my favorite is global trend. So you asked about what do those asset classes look like? Well, global trend, in my opinion, is essentially going global. That's one thing, but also diversifying across all kinds of asset classes that aren't typically associated with a traditional portfolio. So I'm talking about agricultural markets like soft commodities, coffee and sugar, grains like soybeans, corn and wheat, different currencies, metals markets, energy markets. It's a long list of assets that you can participate in, but most people typically don't. And it's important because you can find real diversification in some of these other asset classes. For example, there's no reason for tin or nickel metals to be correlated with, say, cattle or soybeans or Japanese bonds. You can find diversification if you go out into these other asset classes and bring them into the portfolio. And global trend, managed futures, trend following, whatever you want to call it, macro, is the only asset class I'm aware of that is available to everyday investors and does the work necessary to go find these asset classes that don't have that same trapdoor GDP risk.
Yeah, I love that. And why do you think there are trends and money in trends? And like, what research points to that? And this is something that Josh and I have chatted on internally and have like thoughts on, but I would just love like for the listeners to kind of help understand like these trends seem to be sustainable over time. It's not just like, ooh, we've seen it once or twice in history. Why is there money to be made in trends?
I'm going to borrow a concept from Charlie Munger over at Berkshire Hathaway. He likes, I'm not sure exactly what he calls it, but he likes to invert things. Essentially, instead of working linear from left to right, like most people do, is go to the end and work backwards. So why wouldn't there be trends? Why would everything be random? Why would irrational herd-like behavior, politics, inefficiencies, bureaucracies, fear and greed, why would that all lead to a perfect normal distribution and random markets? That seems pretty far-fetched to me. So historically, you can crunch all the data you want. You can spend the rest of your life analyzing the data, and you can see the fat tails in the distributions of not just financial data, but all kinds of stuff. I wrote a paper a long time ago called The Capitalism Distribution that detailed this for common stocks, but also I did the same research on basketball statistics, baseball statistics, CEO pay, weather patterns, all kinds of stuff. And you see the reoccurring theme over and over is that, yeah, it kind of resembles a normal distribution, but you've got these nasty fat tails. And what happens to create those fat tails are big trends. And trends are just a fact of life. They're a fact of evolution. They're a fact of our environment. And our job is to not be on the wrong side of those trends. That's actually a really important point. People want to focus on how do you make money? That's important. You have to make money. But what's more important is preserving it once you make it. And the best thing that I can do to preserve that capital is to take the steps necessary to not be on the wrong side of those big trends. Think about any financial disaster. Think about people you've known that had a lot of money and lost it all, or businesses that failed. It's almost always the same pattern over and over. They got on the wrong side of something. It started off small. It snowballed into something medium. They doubled down on it, and then they got blown up. And maybe it was a 1-2 punch. It was two things, but those losses are almost always start out small. And not being on the wrong side of that trend, taking decisive actions, very valuable to your compounded return over time. So it's not just being on the right side of trends; it's making sure you're not on the wrong side of them.
Yeah, one way that we try to explain the idea of kind of trend following in general is almost like a dimmer switch, right? Like there's times where it's going to be close to maybe fuller on or less on, and you may be a little darker, like the dimmer switch you'd have in your dining room, right? It's not a light switch on or off all the time. It's going to make those moves where, hey, compensated, it's time to take on risk. Hey, it's time to cut back. And you're never going to be 100% right. But when you do catch a big trend and you stay on it, that's where the returns are made. And so I think that's another interesting piece where sometimes the annual returns can be all in couple trades, right? Like, is that true? Or is it usually just little itty bitty trades that just add up? I'm remembering from different research that I've looked at, it's usually big moves or what, make the day.
Yeah, generally speaking, it's pretty lumpy. If you take a professional trend following firm and have them do a performance attribution of their results over a rolling 3 or 5 year window, and you drill down and you look at what caused those returns when you had big returns, what you'll find is the Pareto principle, or the 80-20 rule, is usually in full effect. 80% of the returns came from 20% of the positions. And that's just a fact of life. We wish that everything worked, and you got this warm, steady stream of income from all your different positions. And a lot of people try to do that. They just end up being disappointed because that's not how the real world works. So I would say, yes, it's lumpy. And most of your gains typically come from a small number of your trades, kind of like a baseball hitter or a power hitter in baseball. He's not hitting home runs 8 out of 10. It's 2 out of 10 or 1 out of 10. He's hitting triples and home runs. So that's the best you can do, is to get on the right side of those trends. You're going to have a low winning percentage, and that's very effective. Now, if you tune your models to get a higher winning percentage, you can have a higher winning percentage, but then the ratio between the size of your gains and the size of your losses comes collapsing down, and it's much less profitable over time and much less valuable at delivering the diversification when you need it the most in hostile market conditions.
Yeah, and I'll let Josh jump in here, but I think that brings up a question that I wanted to ask, which is kind of the idea of the cost versus benefit, right? Like, so many people, I think, get stuck into the world that we're in now is like, if it's not free or the expense ratio is next to nothing, like, I'm not going to own it. Mm-hmm. And so the thing that you just talked about is being able to have those like outside winners, or the time of the trend, like it really is there to save your hide. Can you talk about the idea of like capital efficiency and like trying to understand, okay, if I'm going to do these other things, but then I add this net, I would imagine most people are fine paying for something if it truly provides a benefit. But we live in a world where it seems to be like months or quarters, and they look at it then and like, well, this thing sucks and it's expensive, so it's getting out of here because I can go get this thing for free and it did really well. And then fast forward to 2022, and all of a sudden people are like, maybe there's some merit to these other ideas.
Josh, is that the question you wanted to ask?
Yeah, I mean, well, it's, obviously in our neck of the woods, dealing with financial planning a lot, we're dealing with real humans, and, the investments can get sort of overshadowed in terms of the pure concept just by, behavioral finance and things like that. So like more often than not, we tend to be preaching kind of the reasons for having a specific position in a portfolio. Like I can remember very specifically, like a client was like bashing commodities because it's commodities have obviously been terrible for the past decade or so, at least up until today. Mm-hmm. But this was like 2 years ago, and I was like arguing over and over and over why you should have commodities in a portfolio, and then boom, inflation hits and now they're wonderful. But 2 years ago, not necessarily the case. So, and we find this kind of with a lot of types of strategies, like trend following included, where, that short-term thinking. And so, I'd love to hear kind of your thoughts on, how do investors kind of wrap their heads around that, especially when it comes to kind of a financial planning context, or like when they're sitting at a dinner table and all their friends are talking about how Tesla 10X'd, and they're like, oh yeah, I got 3% return this year in my trend follow. But, but now like we're in a situation where it's obviously doing really well and they get to be the ones bragging at the dinner table. But how do you kind of wrap your head around just the difference in time, perspectives and things like that, if that makes sense?
What's worked best for me historically when I come up against that, and everyone comes up against that, and it's an issue of comparing apples to oranges. And I've tried a lot of different things. And the one that worked the best was to, again, invert Charlie Munger style. So take a portfolio that you think is a good fit for a client. It's diversified, and it's calibrated to meet their needs long term, and isolate an asset that's in there. And it's obviously important because it's in that portfolio. Isolate one that's got a fee that is uncomfortable to the client, and remove it from the financial plan, and see what happens to the equity curve, the drawdowns, the volatility, the Monte Carlo simulation, like all of the glide path, all of it. See how much deterioration there is from removing it, and ask them, is it worth it? We got the high fee. It's charging, 1.5%. We got it out of there. But if your plan got weaker and more erratic, and the returns went down and the volatility went up, is it worth it? Because we saved you that 1.5% on, say, 10% of your money. But what it cost you, the deterioration in your plan, much more valuable than what you saved. So that's one way of doing it. And I think that one's intellectually honest, because it allows them oftentimes it's the first time in their life to actually see the risk reward of that decision. So, and this is especially important when you're dealing with like true diversifiers. I talked about earlier, there's only a couple asset classes that truly stand up and deliver when you need it the most, when the stock market and the bond market are declining at the same time. they tend to appear to be more expensive. And there can be long stretches where it feels like you don't need them. No hurricane hit for 3 years in a row. Cancel your hurricane insurance. Why are you wasting money on that thing? So, and then when you actually do need it, well, it's too late now. You're going to have to build a new home, preferably 5 miles inland. I find people are reasonable when you break it down that way for them. Everything else, and I have other arguments about what the true cost is. Like most people don't realize that when they pay, 50 basis points for an equity index fund, the management fee is really about 12%. It's at the corporate level. You're getting the net profits after all those people get paid, and the mutual fund manager just tracks an index. So you don't see that 12%, you see the 50 basis points. But usually that argument, doesn't go very far. Take it out of the portfolio, see the deterioration, that moves the needle with people.
Yeah. And then thinking about the amount, so you have the diversified portfolio and you think about trend, managed futures, macro, whatever. Is there an amount? And again, I know it always depends because we get these questions, right? And you always hedge oh, well, it depends on the situation. So I get that if I'm going to ask a question where you have to answer that. But is there a percentage where it's not going to move the needle? And there's a percentage that's you need to commit to at least this to make a difference to where you actually feel it.
So there's two ways for me to talk about that. There's in our portfolio. So I'll just give you the raw math. So if you take global equity beta going back to say 1970, and you take global trend beta going back to 1970, and you calibrate them to have the same volatility, say they both have 15% volatility, and you mix them together in varying amounts, what you'll find is that 50% allocation to each yields the highest Sharpe ratio portfolio, the highest Sortino ratio portfolio, and the highest Calmar ratio portfolio. So that has just equal risk contribution. So I haven't gone back further than 1970. It's kind of hard to do because the data gets a little squirrely and less trustworthy back then. But that's been consistently true every time I've looked at it for decades now. I mean, that's 5 decades.
Real quick, Eric, let me just sort of interject and kind of just layman's terms, some of those terms real quick, just because we might have some listeners that just aren't as familiar with what the Sharpe ratio and stuff is. So just basically what Eric is saying is by mixing those two different asset classes together, you get kind of the best risk reward ratio by having them together as opposed to separately. And there's just a lot of math that goes into why that is, but that's basically what is happening.
Yeah. And Sharpe is volatility up and down. And then Sorrentino is just
downside
down. Okay. I was trying to remember. Where because no one ever complains upside volatility. I'll take that all day, right? There's nothing wrong with that. It's the downside volatility that makes people squirm a little bit.
Yeah. And then the Calmar is your return divided by your worst decline or your maximum drawdown.
Okay.
So that's my personal favorite. But I use all three because they're kind of picking up on different estimates of what risk is. So yeah, thanks, Josh. That makes sense. I sometimes forget that not everyone is interested in all these ratios and whatnot. So we need to explain what they are.
They definitely are. But yeah, some of the people might not be. So that's where, but yeah, sorry to interrupt there. Yeah, continue on.
No worries. So let me elaborate a little bit more. So you could think of it as the optimal temperature for bath water is 100 degrees, but when you turn the faucet on first, it's cold water comes pouring out for a while. Right. Well, not here in Phoenix, hot water comes pouring out. It takes 2 minutes for the water to cool down. But anyways, where you live, cold water comes out. So you crank it all the way to hot and you run it until it becomes hot, and then you put it back in the middle. The maximum Sharpe ratio would equate to, 100 degrees because that's the optimal bath temperature or water for the temperature for their bath water. But there's a couple different ways you can achieve 100 degrees. You could start off with, 2 50-gallon drums. One's got 33-degree freezing water and the other one's got, 267-degree scalding hot water. And you can pour them on the person, one and then the other one, and their average temperature will be 100 degrees, but they're also going to be in the hospital and suing you. Or you could mix them together ahead of time, put it in the bath, and it can slide down into and say, well, I like that. So that's what we're trying to do with the mixing the assets together for the client. They don't have to experience the crazy downside volatility and the crazy upside volatility. By diversifying across hot water and cold water, we're delivering warm water. And that allows investors to actually stick with the investment and not panic at the bottom, making your life hopefully easier.
Yeah, absolutely. I think Corey Hofstein, I love the quote that he had where it was, the ideal portfolio for any investor is one they can stick with. It doesn't have to always, maximize their greatest return. And we'll chat with people on that a lot. It's hey, so many times if you're going to save at a higher rate, maybe you don't need as much return. And it's the same idea of I can get from here to, another city and go 150 and get there really fast. But the odds of me getting pulled over in an accident are increased. So it's we can calibrate that and see what makes the most sense. But yeah, I love that idea. And the analogy of the water, I think is an easy one for people to understand because you think about getting boiling water poured on you, that's not going to be great.
We've all been there. Yeah. Right.
Yeah. What about the idea of So it's broadly diversified. And then is there a point where it gets to where I think that, I don't know if this is the actual term, but like the diversification where it's like, this doesn't add any more bells and whistles is not going to be more beneficial versus this is kind of the optimal amount. And then how do you think about that?
Diversification. It is a word. It's not a real word. Webster's doesn't recognize, but we use it in our industry. So there's over diversification and diversification. So let's talk about over diversification for a minute, because that's a little bit different. That's simply going too far for the client. It's like, well, when you go from one stock to 10, you're increasing your diversification exponentially. I mean, it's an enormous increase in diversification. As you go from 10 to 20, there's some meaningful diversification. Once you get past 30, the marginal benefit is very, very small, historically speaking. So if you go up to owning every stock in the stock market, that's mostly a need for scale and capacity. There's not a lot of benefit. It's not a lot of harm either, but there's just not a lot of benefit to doing that. So a lot of people will describe that as over diversification. You just don't need more micro cap and small cap and all this other stuff on top of what you've already got. It will make a tiny difference. It's not going to be measurable. Diversification is something else. That's when you take away from investments that you have conviction in, that you believe in, and diversify just so you can say you're diversifying. So you take away from, say, the stock market and you put it into some alternative investment that's 89% correlated with the stock market, but it's got higher fees. And then you find some more alternative investments that are 94% correlated with the stock market, and they've got even higher fees and they've got liquidity problems. Right. That's diversification, where you're essentially saying, I want to take the same risk, the same downside risk, but I want higher fees, higher taxes, and more fragility and no ability to get out. So that's what we see in a lot of the alternatives. I'd say 85 to 95% of the alternative space are opportunities to enhance your diversification. So unfortunately, we all get lumped into alternatives. If you're not stocks, bonds, or real estate, you're alternatives. But there are some that are meaningfully uncorrelated with the stock market and have a tendency to stand up and deliver during hostile periods. And that's not diversification. That's true diversification. Now, it's scary because being uncorrelated with the stock market opens yourself up to situations where the stock market's soaring and your alternative investment is either going sideways or maybe even down. And a lot of people can't handle that. And they feel like they're getting left behind. And that's the behavioral finance that both of you have talked about, for years now. So a firm like ours tries to deal with that by mixing the assets together, the hot water and the cold water, to create warm water that people can actually hold on to and not freak out about over the long term. So I don't know, is that helpful, Isaiah? That diversification is different than over diversification.
Yeah, you answered a question that I couldn't quite ask the right way. So thank you for bailing me out by adjusting that. No, that was perfect. And that's where I was trying to go with it, because you say, hey, this is what I do, and I'm an alternative fund. And instantly there's going to be a subset of people that will never allocate there because they think of high expenses. There's no real benefit. And I think that's one of the challenges that I've ran into with peers or friends or clients at time, where maybe they've been burned in the past or bought something for the wrong reason. And I know the story when I was at Merrill, the guy that I worked with, he bought managed futures in 2009 after they had an awesome year and was like, hey, you should buy this fund because this did really well, right? People coming in and selling it for the wrong reason, buy it. And it just does terrible as equities just run, right? Mm-hmm. And so I think for a lot of people, it's like, why do you own it? What is it there for? What is it trying to accomplish? And as long as you understand that, and you can say, this is an allocation I'm going to hold over the long term. And that's what I always crack up about. Hey, I'm a long-term investor. It's like, well, then you should look at the evidence for why these certain pieces come together. And a lot of people just don't want to do that. And that's going back to that initial question. Everyone just says stocks and bonds because that's easy. And that's what they know. And that's what, wealth management's been built on since the 1980s. And you see interest rates go down, and that's been helpful. And maybe the world changes for the next 40 years. We don't know, but that's one nice thing with trend is you don't have to predict or understand what's going to happen. You just adapt and let price be truth. And I think that's kind of interesting.
Yeah, you young guys don't remember back the last time that stocks and bonds were not popular. It was the early 80s. After the 1970s, where stocks and bonds struggled terribly together at the same time for 14 years. There's a book, I think it might be Liar's Poker. There's a famous quote in there that when you graduate with your MBA and you get hired on a Wall Street, the worst possible thing can happen to you is you get sent to the equities department in Dallas, because nobody wanted to work in the equities department. They wanted to be bond traders, and vol traders and whatnot. So that was, I think, 82, 83, 84, something like that. So also the beginning of one of the greatest bull markets of all time. But at that time, no one had any interest in stocks or bonds. So they just wanted tactical, they wanted commodities, they wanted this other stuff. So they basically went from cold water to hot water and they were wrong again. So because it ended up 80s were a great decade for stock and bond investors. So the moral of the story is if you can diversify away, hold your stocks and bonds, but diversify into true diversifiers globally, mix them all together and enjoy the warm water.
Yeah. And Eric, one of the things that, we've kind of alluded to this, but, from like behavioral side of, a more traditional 60-40 portfolio, like we've all sort of heard the statistics around like, most average investors get terrible returns because they can't really stick to the strategy. They get emotional. They sell their stocks when things are going like they are now because they don't have a hedge, et cetera. Do you have any data or kind of insights into sort of the differences, in terms of being able to stick to the portfolio that for a more retail style investor? Like, is there any data or anything that backs kind of the idea of like, hey, you're more likely to stick to an all-weather portfolio through thick and thin and therefore get better returns aside from just the true portfolio optimization? Is there anything that sort of exists around the behavioral side in that regards?
I'm not sure if there's anything conveniently available. I can tell you about my own experiences and some of the anecdotal and indirect evidence that I've seen which has piled up for decades now. I can start with my own kind of unscientific experiments I've done with people where I've sat down with clients, both retail, financial advisors, hedge fund investors over the years, and showed them the annual and monthly historical returns of different asset classes and had them anonymized, meaning they don't know which one of these asset classes is stocks, gold, bonds, managed futures, long short equity. They just don't know. So when you anonymize these things, and then down at the bottom, they can see the annualized return, the annualized vol, the worst decline, and then the average correlation with the other asset classes. And then I ask people to, let's build a portfolio, pick your number one favorite foundational asset class, and they'll go across and they'll pick the one with the highest risk adjusted returns. And they'll say that one, and they'll say, all right, we're going to put 40% in that one. Pick your second favorite, and they'll scroll around and pick the next highest second, risk adjusted returns. And then when we get towards the end, I would say you got to pick one that you never want to invest in ever again in your life. And they would always pick the one with the highest drawdown and volatility and whatnot. And then I would reveal, I would show them what they did. And almost always they did the exact opposite of what they do in real life. So they would pick trend as their number one asset class, and they would eliminate the S&P 500 as something they never want to invest into in their entire life. So when you take all the emotion out of it and you don't have to survive the path traveled and the news and CNBC and the Wall Street Journal and your friends at the country club and all that other stuff, and you're just objectively looking at the data, people do the exact opposite of what they do in real life. That's valuable information. Now, it's not a great sales technique because most people don't want to be convinced to do the opposite. There's a reason that they're doing the exact opposite in real life. There's a series of reasons, but that's not the question you asked. You asked for evidence. So there's things like the Dalbar study that show the more people pay attention to stuff, the worse they end up doing. There's that old story, and it's true. I can't find the source, but the best performing 401ks in the world are forgotten 401ks. People didn't even know they had them. They're a mess and they forgot, and it just because they left it alone and they didn't get in there and say, hey, I want to go buy tech stocks now, or I want to buy this, or I want to get out of that, and I want to go chase energy markets now. They just left it alone, and those things had a much higher compounded rate of return. You could join Congress. Those folks have a 30% annualized return somehow, but I don't do that. You'll go to jail.
Supposed to go to jail. It doesn't actually happen though, right?
Yeah, not them. What else? So my personal experience, your personal experience with people that if they have a plan, and it's not their fault. We all are the same like that. If us three stepped out of our discipline and went into some other area where fear and greed and envy and all that stuff works against us, if we didn't have a plan and we didn't know right from wrong, we'd be on the wrong side of the equation too. That's why clients hire you and pay you. But I think that delivering them a plan and an experience is more important or more effective than sitting down and trying to explain the math to them. Just like I don't need my dentist to explain microbiology to me. I just need it to not be painful and to be over in less than an hour. Just do a good job. Okay. That's all I'm asking. That's all they're asking of us.
Makes a lot of sense. Yeah. Yeah. Those Dalbar studies are the ones that for anybody that's not familiar with those, basically what it shows is like the average retail investor, like if let's say the S&P 500 returns 9% year over year, well, most average retail investors get like 3% return because they, buy at the wrong time, sell at the wrong times because of emotion. So our argument is, and with like all weather and like minimizing drawdowns and things like that, were all the things we're talking about. is that, by minimizing those emotional factors, you can stay more consistent and stay invested more, or have your forgotten 401k kind of the same equivalent to where, hey, now you're actually getting the 9% return instead of getting the 3% return by just letting the investments do their job. Right. And that's
and it's even worse for bonds. Like the Dow bar is even worse for bonds. But no one's done this, but my theory is that if you mixed stocks and bonds together and you did a Dow bar of that, it would be much lower, because stocks and bonds in most market environments provide a much smoother ride than just stocks or bonds alone. Not necessarily lower volatility, but the risk reward is easier to stomach. Now, if you get into an inflationary environment or unexpected inflation, that's no longer true. And that's where we've been for a couple of years now. And that's where stocks, bonds, and global trends combined together produces the really warm water that people can actually stick with. So it's an astute observation that if you take away the triggers for fear, greed, and anxiety, you shouldn't be surprised when people feel less fear, greed, and anxiety, and therefore take less action.
Question for you, and I don't know what direction you want to take this, but you look at historical, 1970s, 1980s, and you use this in projecting out in different environments of what it looks like. But then you have kind of the age of, since the great financial crisis, this monetary expansion, right? Free money, drop it from everywhere. We'll figure it out later. Does that impact and change the way that trends look in the way that you think about things? But to me, that's a struggle that I've had at times when looking back historically, just because some of the dynamics today are so different. And if you think about, hey, it's all just flows of money, or whatever the Fed says they're going to do, or what CPI prints, or what is the definition of a recession? Like all of a sudden we're like reframing all these things. How do we still look at historical data and feel confident that can be reliable moving forward?
Yeah, there's a couple different, like you mentioned, there's a couple different ways I could interpret that question. I'll tell you this. When I analyze historical data, I like to do everything on an inflation adjusted basis. And sometimes I even try to do tax adjusted, and it's hard because tax policy changes so much over time. But I like to see what's the true net real rate of return. Because you could take something like the 10-year treasury, which appears to have a 7% annualized return over the last, say, 40 years, up until last year. But if you charge management fees and factor in inflation and the trading costs as well, that number is more like 50 basis points. It's not 7%. So, and that was during the good times, right? So it's important to get a feel for how much wealth is actually being created from any of this. So when you do stuff like that, you start to get a more normalized result that's more consistent through time. I think that's what you're alluding to, that if the monetary base is tripled, how real is some of this stuff, right? So, and there's no perfect answer. So where I want to take this, though, is to say, in a nice way, I don't care, because we never get to trade the past. We don't get to invest in the past. All we can do is invest in the future. And those good habits, I call them good habits, that I've learned from the empirical data are what I'm going to rely on in the future. And that is my winning positions. I'm just going to be hands off, and I'm going to let them take care of themselves until something goes wrong. I'm going to be very aggressive at keeping my losses small and very disciplined about that. But I'm going to be very liberal and hands off on my winners, because that has been a winning philosophy throughout the entire history of humanity in almost any context, not every context, but most competitive, capitalistic type contexts. That's a winning strategy. So I don't really care about M3 and M2 and the Fed's balance sheet as much as other people do, because I have a plan and a strategy and the discipline to stick with it long term. And I believe it's a winning strategy, given all the plausible scenarios we have going forward. To what degree, whether I'm a hero or just I got ahead, that part's not up to me. All I can do is stay disciplined and stick with the strategy. And I'm willing to do that. And you got to, at the end of the day, you're going to have faith in something, because your feet will get held to the fire, and you will face that inflection point where you have to make the decision. Are you in or are you out? And having that ahead of time is beneficial. And agonizing too much over, is the data from the 80s relevant today? Because, or like when limited liability came into effect back in I think the 30s, pre 1913, before the Fed. I mean, it's just, those are endless circles of debate and rabbit holes that are interesting. I do spend some time on them. At the end of the day, just having discipline, realistic expectations, and a strategy going forward puts you at such an advantage to most market participants. You should just be happy with that and get on with it.
I love that answer. Thank you. I was like, I don't know. It's easy, right? It's easy to ask the questions. It's like, here, I'm going to ask this question that I don't think has a good answer, but let's just see what Eric says because I'm curious. So thank you.
Yeah. And I think you nailed a super important point there too, that I think is often forgotten is that, a lot of times just having a strategy that you stick to trumps everything. It may not be the best strategy in the world, but you're still going to be in the top percentiles just by the fact that you have a strategy and aren't just going off gut or the changing movements of the herd or whatever the case may be. Just having a strategy based on an empirical evidence as best you can do. No one has a crystal ball. That's still going to be outperforming most things just by that in and of itself.
Yeah, and getting those nuggets of wisdom, those rules of thumb, is incredibly valuable. Here's one I haven't thought of in a really long time. So I've known about maybe 15 or 16, maybe 17 former floor traders, people that traded in the pits in Chicago. And I would say half of them were wildly successful. They made a lot of money. Of the remaining half, about half were break even, and the others just, they blew out. Lost a lot of money. And what occurred to me, and this is maybe 10 years ago, I realized this in a conversation with one of them, is the winners, the guys that made a lot of money, they all had one thing in common that none of the other guys had. And it was a rule. It was essentially a stop loss. That was just a simple arbitrary rule. If I lose more than X at any point in time, I'm closing down, I'm leaving the floor, and I'm not coming back for X days. And they all had some different variant of the rule. It's like, well, if I lose more than 3% of my entire net worth in one day, I'm going away for a month. Or another guy had, if my personal P&L goes below the 20-day low or 20-day moving average, can't remember what it was, but they all had a red dot. And when you cross that red dot, they just, no questions asked. That's my signal that it's time for a vacation. So some of their wives were like, when are you going to hit the red dot? It's time for vacation. That was it. And you guys know how hard it is on a Tuesday at 10 a.m. to look at the screen and see you're down $50 million and you're like, all right, I'm going to book this and I'm going to go lick my wounds and sit in a corner and feel like an idiot for some period. Nobody wants to make that decision, but you have to, because those losses have to be kept small before they snowball into something that you can't come back from. And if you have the discipline to do that and you already know that's a winning formula and you're totally okay psychologically and emotionally with doing that, you're at such an advantage to other people over the long term, and other people will outperform you for 6 years in a row. They look like geniuses. And then one day you're saying, hey, where's Kevin? He's not in business anymore because he had the 2 down quarters and it's game over. So you got to decide which one you are. And you don't get to choose. You are one or the other. All you can do is be honest with yourself.
I have a hard transition random question that I wanted to ask. And it is not in any direction of where we've been so far. And anyone that listens to this podcast or has heard me talk, I'm curious because there are now Bitcoin and Ethereum and other futures. Do you look at adding that ever? And have you done any research? Because I've asked other trend or managed futures managers, and a lot of them had said it's not big enough, it's not liquid enough, they don't want to trade it yet. I'm just curious your thoughts there, because I'm more focused on Bitcoin, but just what your thoughts are around that as something that may fit in or not fit in.
Sure, it's fair. So our job as a trend follower this is the way I see it. Our job, the reason that we're allowed to extract a risk premium from the markets is because we provide liquidity to hedgers in the futures world, right? It's a zero sum game. It's actually negative sum if you factor in commissions and slippage and whatnot. So for us to make a 8, 10, 12% return a year, someone else has to lose some fraction of that in a leveraged manner on the other side of the trade. There's only one group of people in the world that are willing and able to do that, and in fact benefit. The more money they lose in the futures, the better off they are, because they're using futures as a hedge to their core business. So if they're making money in futures, it means they're losing money in their core business and vice versa. So you want to find those people. Well, those are the big commercial hedgers. They're the reason that these futures markets exist in the first place. So by providing liquidity to them, we're at least on the right side of plausibly sustainable risk premia long term. Well, it turns out that they love to fade trends. I know I used to work with commercial hedgers back in Kansas when I was in college and right after college. So I was also a cost accountant. So I know that their incentives are to sell rising markets and to buy declining markets. And if they made money on their hedge, that means they're making money on their insurance. So think about that inverted, crazy world where you made money on your car insurance and your health insurance and your fire insurance. Well, same thing for them. They're using the futures markets as a form of insurance. So it doesn't make sense for them to make money on it, which means there's a risk premium available to collect if you know how to do it. Well, it turns out that trend following on a dollar weighted basis puts you opposite the commercial hedgers most of the time. So it just makes sense. And having that peace of mind, or at least understanding why what you do isn't just chasing numbers on a screen, that it's actually providing a valuable economic service to the marketplace, allows me the confidence to stick with it. Sorry, did I even answer the question, or did I just go off on my own tangent there?
It was a good tangent.
Bitcoin. Yes.
Yeah.
So yeah, that was it.
I didn't want to interrupt you. I was like,
I must have really wanted to get into that. So hedgers have size. Right. Until we see more volume and open interest in Bitcoin and Ethereum futures, we can't really put it in the portfolio. We can put it in the portfolio, it won't make any difference yet. Mm-hmm. So they almost made it in, or Bitcoin almost made it in the last time. I do this twice a year. I reevaluate the portfolio. I'll add it in as soon as it's one of the 75 most liquid futures markets in the world. It's just really not that close to being there. And once it's in, we participate on a liquidity weighted basis in order to ensure that we're in harmony with those hedgers, or anti-harmony, I guess, because we're trading opposite them. But I'm actually hopeful that the cryptos will have hedging pressure. I just don't know if it's going to show up in the futures markets, or if the crypto space is going to create their own outlet for hedging internally. So I'm not clear on that one yet, but the futures are there. They're reasonably liquid now, but they need to get quite a bit bigger before we add them into our portfolio.
That's what I've heard in the past. So perfect. Thank you. And in the story and the analogy you gave before fits why that made sense though. So it's perfect. It all flowed.
Yeah. And you guys know a lot more than most people do about the cryptos. I mean, is there demand for hedging, or is it easy to just, if you want less risk, you just lighten up on your crypto holdings? I always figured there's got to be demand for hedging because they're taxed like property, right?
Yep. Yeah.
So absolutely. You don't want to be selling your asset. You want to be hedging if you have an effective hedge.
Yeah, I would think I think part of the maturity will be that will grow. And I think the announcement from BlackRock and Coinbase recently about how they're going to start putting that in, which I think is interesting, to their Aladdin portfolio software, because they're seeing client demand. And Fink was on, I don't know what webinar or something, but he was talking about like inflation and the search volume, and then, the global economy or macro search volume. And then it's like 3,000 clicks. And then Bitcoin was like 600,000. And so BlackRock's like, hey, we have all these assets. We have this demand. We need to make money somehow. And I'm by no means a fan of BlackRock necessarily even getting in the market, but it's like, they see the demand and they're like, we know that there's demand. And if we don't do it, someone else will. And so I think over time that absolutely will develop. So it'll be interesting when it does make it in the top 75, and you have to ping us at some point, but hey, it made it in. It's in. So
yeah,
I think they'll be there.
Yeah. I think what we're seeing now is just, kind of proportionally to the more traditional markets, we're seeing, I think, a much bigger proportions, probably more retail type investors, just because a lot of institutional can't really touch it yet, or you aren't confident touching it yet.
It's too small.
Yeah, exactly. But I think as the space grows, and as you get more institutional players in there, the institutional players, I think, are going to be the ones that are going to really push for the hedging. I think a lot of the retail investors don't necessarily know hedging exists even.
Yeah, those guys don't want to hedge. They're there for the risk.
Yeah, they're Wild West gunslingers, right? So like that's exactly. So I mean, I think eventually I think it will mature to the point where there will be a lot of hedging strategies in the crypto space, but just right now we're not seeing it.
Yeah. How do you guys feel about crypto as a portfolio diversifier for people that, let's just say, someone my age, 50 years old, let's say I worked at Boeing and I made, 150 grand a year. Do you see a spot in the portfolio for cryptocurrencies for someone like that?
Not crypto, but Bitcoin. Yes.
Okay.
I think there's a big difference between those. Gotcha. Fidelity did a great report called Bitcoin First at the beginning of the year. And this is my thought around it is, Bitcoin is its own asset class. What Bitcoin is just better money, right? And I think the total addressable market and demand for better money around the world is significant, right? Like that's the ultimate product. And if you think about everything else, it's venture capital. There's lots of zeros. And if you have information or are able to trade it, possibly there's money to be made. But as something that you can save into, and you can even look at, there's been some reports done by various different firms. You take the 60-40 portfolio, you carve off 5% of stocks and bonds, risk does not change, performance increases. Like that is positive. You look at Sharp, and I ran a report and I wrote something for CoinDesk for their advisor newsletter, because I talked to my peers about why Bitcoin matters and why they should have an allocation. And even after a 60% drawdown that we've seen in Bitcoin, and you run the numbers over 3 and 5 years, it's still positive if you rebalance. So to me, it still makes sense. And yes, absolutely. It solves for a risk that is different than everything else. And I think the key thing is, if you're going to own Bitcoin, you need to hold your own keys, just like anything else, like actually take self-custody, because, that is the ownership of the asset is who holds the private keys. And I have to ask for permission. I don't really own it. I have an IOU. And I think there's a lot of paper Bitcoin out there that you want to make sure that if it's a 21 million hard supply cap, I want to verify that I own my chunk.
I think kind of like some of the arguments around gold too, like the leasing and paper gold.
Mm-hmm. Yeah, exactly. And I think as kind of, again, with the maturity of the market.
He froze.
Yeah. We wanted to kick Josh off. He was going to talk about why he disagrees with me. I'll do a screen capture and draw pictures on him. We'll keep this in though. But yeah, I've had more conversations around Bitcoin across age ranges. And I think it's just more of what's the allocation and where's the comfort level? Because yeah, it's not, you talk about volatility, like that's the ultimate volatility. Like, a 15 or 20% down day, that's a slow Tuesday. So you need to make sure that you're comfortable with what that can be. But there can also be days where, it's going to go the other way, and no one's mad when it rips up 10% in a day. That's fine. Everyone's happy, but it's the days where it's on the other side. So I think it's just more of a weighting percentage base of what it is. And yeah, no one should have 100% Bitcoin unless they really, really understand why they own it and want to get there. But for most clients, it's just trying to understand like, what the hell is it and what's the difference? I think.
What do you think about my coworker Matt's idea to buy a leveraged natural gas position, but using Bitcoin as the denominator? That's a joke, because natural gas moves 10% a day and Bitcoin moves 10% a day. So and then leverage that up, and you can have something that's your risk of ruin can be literally in an hour.
Yeah, it's like, and they're gone. I thought you were going to talk about natural gas and using it from like on the oil pads with the flare gas, right? So what you're starting to see is these off-grid miners tapping in instead of flaring it. They're just hooking up Bitcoin miners remotely and mining it. So it's better from an environment perspective. And it also just adds to the bottom line for a lot of these oil and natural gas guys. So I think there's this interesting dynamic playing out in Bitcoin with energy producers. And it's, I think the question that's being asked in that space is, are energy producers going to become Bitcoin miners, or are Bitcoin miners going to buy up energy producers? And I think it'll probably be the energy producers because they have way bigger cap tables and assets that they'll be able to swallow everybody else up.
Yeah, that makes sense. I've heard the same thing. I avoid getting too deep into it because it's very interesting. But I've got I got my day job and my night job, and I need to do one thing and do it well. So.
Gosh, you were saying, and then you froze, and we took pictures, and we'll post it into the YouTube of this too, so we can draw faces on you. But Eric and I,
fair enough.
Some fun.
Sounds good. Yeah. And I think I somehow unplugged my camera. I don't know what happened, but yeah, can't remember my train of thought. But I basically was thinking that it was just along the lines of, I think as the cryptocurrency markets mature, we'll start to see much more of these kind of things playing out where like, I think we'll actually see some different correlations. And I think things like Bitcoin especially will be real true diversifiers, especially like when thinking of like an all-weather type portfolio, just because I think long-term it's going to be, maybe not necessarily the inflation hedge and stuff that we all expect long-term, but I mean, I think it definitely is going to have a different risk reward ratio than stocks. Right now, I think it's a little too heavily correlated to tech stocks. But I think everyone just sort of, again, retail investors see Bitcoin, they see tech, and they kind of think they're the same thing, which they're obviously not. But I think, again, as you have more institutional players that will know the different risk rewards, you'll start to see it as a real true diversifier to have in a portfolio long term, which I think will be sort of interesting to see play out. But yeah, to Isaiah's point, a lot of the other currencies, I think if you could treat it like a venture capital type allocation and do it well, or have a, say a hedge fund or an actual like PE firm that invests in those type of things and then does it well. Yeah, it could be a really interesting piece of a puzzle, but I think the average retail investor is probably going to get burned more often than not trying to use that as a diversifier.
Sounds like that's a security if there's people that are investing in it, doesn't it? That's kind of strange. Anyways, I'll leave that alone.
Yeah.
I wanted to close with a question to you, Eric, and maybe you've kind of already thought about this, but if you could ask all investors one question and they had to answer you and give you like an intellectually honest answer, what would it be? Was there anything that you would try to pose to them to help them think through how they invest, why they invest, the style of investing?
It's hard to come up with one question. What I would try to get investors to face the gap between their wants and their needs. That's what I would try to do, because that's what's interesting to me. Here at Standpoint, all we're doing is mixing fundamentally different asset classes together to create a much more stable experience that people can actually stick with. It's not that complicated. It's not novel. And it's been known for a long time, but for some reason, not too many firms do it. And I think investors, there's so many investors that would love this if they knew it was available. This concept of, I much prefer the balanced, warm bathwater approach, and then just not try to be a hero, because people that try to be heroes in this business generally fail. I've got databases all over these computers behind me. It's really hard to find any asset that's got 20% annualized returns. They're exceptionally rare. Yet everyone's out there chasing 30 and 40% returns. When that's not what they need. So if I could distill it down to one question that would get them to face the gap between what they want and what they need, that would be so empowering. And what we're trying to do is to help people want what they need, rather than just do a sizzling job of giving them what they want, knowing that it's different from what they need. So let me ask you guys a question. So our original thesis, we're 3 years into this now, was that trend and equities combined in a responsible manner with approximately equal risk contribution is probably the optimal portfolio for people, that for both returns, volatility, drawdowns, and the daily, fluctuations for people. And we've gotten results that everyone can look at and feel. Do you feel like that thesis, is that enough evidence to drive home the point that, yeah, this actually makes sense? And if so, what problem is that solving for anyone? Am I right that it solves a problem?
I would say yes. The second thing I would also talk about is like the timing of the launch of when you launched was really interesting, because we've seen so many things happen, right? You saw COVID shut down, you've seen inflation, you've seen, equities go on a rip after, kind of the stimulus and QE of like, hey, we're going to go fix the problem by throwing. So you've seen a lot of different environments in a condensed period where the strategy is done really well. The way that I think about it is, again, if someone could stick to the plan and consistently save, and they see that, hey, the portfolio fluctuations are not so great, that helps. And a lot of our clients typically are working mid-career, getting closer to that kind of work optional standpoint. But I also look at it from, if I'm a retiree or I'm someone at the other end of my career, I'm taking money out, the consistency of returns and what you all do is fantastic for that. And so to me, that idea of trend fits well. And it works across the spectrum, but especially if you're going to start taking money out, to me, I think that makes sense. The challenge is always just getting, I think, advisors to be like, own something other than stocks and bonds, which is why I started with that question, because I hear that all the time and I chat with my peers, and I think you can just drive yourself crazy. And if I was sitting in your shoes, Eric, it's like, look, this works, and people just still won't listen to you. But I think it does solve a need. I think it has done something interesting. And typically my understanding of a lot of trend or managed futures in the past has always been, the idea is that a lot of it's been held in bonds. And so when those interest rates are so low, like what's the return characteristics? And does that change where you've kind of said, hey, we'll just add equities to that on the other side. And so it's just a little bit of a different flavor. And no, it's absolutely worked. And the quote of the proof is in the pudding. You just kind of look at what's going on. And
yeah. I think at the end of the day, my philosophy is go out and do it and show people. Prove it. Stop talking, stop arguing with people, stop writing papers, stop doing experiments, even though they're fun and they're very insightful. But on one level, you have to do it and eat your own cooking. So we said, well, if we have to do it and eat our own cooking, it's going to be this portfolio and this strategy. So we launched that, and here we are. Yeah.
And the other thing that you all did, I think is helpful, is a lot of just everyday people that can benefit from the strategy. It's not in a hedge fund. Like, it's approachable. You can go buy it, and you don't have to be an accredited investor or all these other things, which I think sometimes those hurdles make it tough for people. So that's one thing that I really appreciated when you went out and tried to do this, because that might not be the easiest way to go raise a bunch of money and earn as much as you could. So
yeah, that's an important point. There's several reasons that's an important point, but that was crucial to us, is that it has to be scalable and it has to be available for everyone. I've worked in the accredited investor world, family offices, hedge funds. I don't want to work there. I didn't grow up in a wealthy family. I wasn't a trust fund kid. I came from a blue collar family. I grew up in Kansas. I went to Wichita State. I studied ag economics and finance. I don't need to spend the rest of my life helping the ultra wealthy, get wealthier. Great for them. I'll take their money if they want to buy a mutual fund, but they don't need another. They've already got an army of accountants and lawyers and CFAs and whatnot, and they don't need me too. So my point here is that whatever strategy I came up with needed to be implementable in a regular mutual fund without being watered down and diluted. So a lot of these strategies that work can't be offered in a mutual fund because they use too much leverage, or they're trading things that are liquid, or they're using OTC markets that are negotiated. Whereas just a global trend program with stocks, super easy and convenient to fit inside of a regular mutual fund. I'm truly shocked more people don't do it, but for now, we'll take the lack of competition.
Yeah, absolutely. Blue ocean. Gotta love that.
Love the blue ocean.
you all do put out a ton of content, but for those that are interested in digging a little bit more, we'll put some links in the show notes. But is there anywhere that you would send them as we kind of wrap up to check out or learn more about what you all do?
Yeah, the easiest thing is just go to standpointfunds.com. Right there on the front page, down at the bottom, sign up for our monthly package. We put a lot of effort and good information in that monthly package, and it's a great way to keep up with, on our research and what we're doing and how things are going. So just type in your name and your email address and you'll be all set.
Perfect. I appreciate it. And I've listened to probably 3 or 4 or 5 different podcasts you've been on, and I still learned something today. So I appreciate you coming on. This was great. And thank you.
Yeah,
absolutely. Josh, Isaiah, thanks for having me on. I really appreciate it.
And cut.
Perfect.
Yeah. No, thanks a lot, Eric. That was
awesome.
Seriously. Yeah. Awesome.
Yeah. Well, thanks for having me on. I haven't been on a podcast in quite a while now, so I was getting a little rusty and
did not show by any means.
I was going to say, no, it was good.
I was bitching at Matt the other day and I'm like, dude, I'm bored out of my mind. He's like, we got the Isaiah podcast coming up. I'm like, why didn't you tell me? No one told me. It's like, it's on your calendar.
Yeah. When I sent the invite, I was like, I don't know, schedules and what everyone's got going on. But then I saw you accept it today. I was like, oh, cool. That's great. And Matt could have been here too. He could have talked if he wanted to show his face, but that's all right.
So I think he's sitting there in a black screen.
Yeah.
Yeah.
Like he talked about, it's hard to find people that'll show up all the time. And so he's like, yep, got him on the podcast. I'm done for the day. Heading home.
Could be. Yeah. He's kind of shy, I think, to the public. He doesn't want the people he's calling on the phone to know what he looks like. So just in case he robs their house later on, like he doesn't want the Ring camera to be able to be used against him. So
yeah, I get that.
Last thing from my end, anything upcoming, anything that has you excited, or is it just like continue growth and just continue to get the word out?
Having done this a couple times before, there's something special about hitting a 3-year number, and we're 5 months away from hitting a 3-year number. So I'm going to be curious to see what happens, because at previous firms, you hit the 3-year number and then your AUM really starts to go up after that. Between 3 and 5 is kind of the sweet spot if your track record's decent. And so far, we've been fortunate. The track record's pretty good, all things considered, given the macro backdrop. So I'll be curious to see what kind of demand there is. I mean, look, this whole thing's an experiment, not the portfolio. Like that's my portfolio, but the business model is an experiment. And that is, we're taking managed futures and equities, and it's kind of like chocolate and peanut butter. We're mixing them together and calling it the Standpoint, peanut butter cup, and seeing if our margins, and the demand, if we can create demand that otherwise wasn't there. And is it sticky? Meaning like this actually is solving problems for people. Like if advisors are coming back to me and they're saying, no, man, this thing sucks. Like my clients, like I'm getting more Dow bar from this because it's not hot enough or sexy enough or whatever. And people are getting out or trying to time it or whatever. Then I'd have to reevaluate my assumptions, because I would say I'm not helping advisors. If I'm not helping advisors, then this thing's like a pawn shop model. It's not going to work. Right.
Yeah.
But I think we've only had 2 people redeem in 3 years. And they were both small retail clients that were probably trying to trade the fund anyways. So, and our subscription to redemption flows on a daily basis are like 11 to 1, 10 to 1, 11 to 1. That's the highest I've ever seen.
That's awesome.
Right. So, I mean, we've got very low turnover in our client base and a 10 to 1 ratio between subscriptions and redemptions, 440 million under management in year 2.5 for a new fund family. Like, I think that right now, the report card we're getting is like, that's almost an A+ from the macro environment or the market telling me, yeah, this business makes sense. Yeah. And that's so gratifying because I love this business. My life is great. My coworkers love their lives. That's great. We're investing the way we want to, the way we believe in. Our own money's in the fund. And so finally, we have zero like competing interests. We have zero politics. We have zero conflicts of interest. It's like, no, we would run this fund just for ourselves if we weren't offering it to other people. Offering it to other people doesn't hurt us because the scale and capacity is like $20 billion in the program. So
that's what I was going to ask.
I'm like, I'm amazed. It's like, yeah, you can create kind of a Goldilocks scenario for yourself where you don't have to deal with any of the politics or the hidden, risks in most businesses. Now, if the strategy doesn't work very well, that's on us, right? That's if the regulators come in and say you can't do that, but they've already made all the new rules and I designed the program with those new rules in mind. Those go into effect in about 2 weeks, by the way. So I think you're going to see some turmoil in the mutual fund industry because a lot of people won't be able to comply with the new rules.
We don't use very many mutual funds. You're one of the only ones that we use, just FYI. So
that's what everyone's telling us. They're like, when are you going to convert it to an ETF? And I'm like,
Well,
ETF is kind of a dangerous package for managed futures.
Well,
so.
And I see Andrew Beer a lot making a lot of noise about how, they're managed futures. And I was like, I was like, that's getting way too, I'd be curious, and that could be a conversation for another day. But because I've been told you can't run managed futures well in an ETF. And then he's out there saying, hey, this is the way to do it. This is how it works. And we've kind of cracked this, where I know other, like, I think the Wisdom Tree ETF managed futures was always like horrible. Right. And I was like, yeah, that sucks. His seems to be, at least up to this point, doing decent. Right. So,
yeah, he's a smart guy, but he's taken some risk in the sense that he's essentially copying other people's positions by getting the real-time data on what their positions are from their brokers. And those people can't be happy about that. So if he ever loses the ability to get the positions of other people, it's like going to your competitor and saying, hey, give me your formula and your recipe, and I'm going to create a generic around it and offer it at a lower fee because the regulators are forcing you to disclose those positions to me. So I know they're furiously lobbying for that to go away. I would be if I were them. So if he ever lost that ability, what does he do then?
Yeah. Interesting.
You can't copy these people anymore. So you got to build your own system. And the other thing is, now is a good idea though, and he's trying to create an index of them. But the difference is the money's not flowing to them through your index. So it's kind of like a bucket shop. It would be like me creating something like before the S&P existed and said, oh, you got all these stocks. I'm going to create something that tracks you guys, but you don't get the money. I get the money and I charge a management fee. It's like, okay, that's unbalanced, right? So, and it goes on, and I'm small and they ignore me, and then I'm medium and they ignore me. What happens when I get big and I'm collecting more in fees than some of those guys are? They're going to start to complain.
Yeah.
So I caution people not to get dependent upon his ETF.
Interesting. Fascinating.
Yeah. So, and then also structurally, ETFs are a triangle between the sponsoring bank, the market makers, and the asset manager, right? So we're the asset manager. We're not the market makers, right? So when you go to buy, let's say I start an ETF, you go to buy it and you get murdered on your fills and the bid-ask spread goes to 60 cents. Who do you call to complain? Don't call me. I have no control over that whatsoever. That's the market makers. And if they don't want to do a good job, there's nothing I can do about it. And there's nothing you can do about it. And they're not going to want to do a good job if I'm holding German bonds and the German market's closed and you want to do a $50 million trade. How do they do it? The markets that you need them to buy are closed, and Japan hasn't opened yet. So there's a mismatch between the liquidity and the different time zones. So if you're going to run a managed futures program in an ETF, the market makers who already don't want to trade futures, they like common stocks, are going to do a poor job on the future side. And then if it's overseas, they're going to do an even poorer job because most of them won't even do it. So those are the kind of things that keep me up at night if I was going to run managed futures in an ETF format, as I'm dependent upon these guys that are not beholden to me to do a good job. Otherwise, my clients are getting screwed with bid-ask spreads, and they're calling me and there's nothing I can do about it. So I view that as a fragile business model and don't want to go there.
Yeah, it makes total sense.
Yeah. So, but he's made it work so far. His house is worth like $50 million. So he's not a poor guy. He's got some huge mansion in Connecticut or one of those places right on the ocean. I'm like, this guy must have been born rich because he didn't make that from the fees off of that ETF. But I've listened to him. He seems smart. I think it's easier to just build your own program than it is to go out and copy other people.
Yeah. Interesting. I knew you would have thoughts and insights that, I wouldn't know, but I see him making a lot of comments. I've heard him on podcasts as well, and I agree. He seems like a bright guy, but I didn't understand some of the dynamics that you shared. That's helpful. So
he's definitely full court press right now out there in the media.
Oh, yeah.
Isn't he?
Oh, yeah. I mean, I see it all over the place.
That's the other thing I like about the blend is that, you don't have to go out there and aggressively pursue money when you're up. Right. So like managed futures, other asset classes, like the only opportunity for them to raise money is when they're up 20% for the year. And then they all come out of the woodwork and start screaming at the top of their lungs. I'm not going to do that to people. It's slow and steady. Stay the course. You winning a marathon here, you win through discipline. That doesn't mean hyping something up when it looks really pretty. And it also means don't be a coward when you're down.
Mm-hmm.
Yeah.
Well, thank you for carving out the time. This was great. Really enjoyed it. And we will let you know when we release it. I don't know when it'll come out. It'll be probably a couple weeks, but This is great. So enjoy it. If there's anything that we can ever help with, or you want to chat through anything, if we can ever help, let us know. But we're I'm glad that I was able to find you all through, it was through podcasts when I remember you were launching, and I was like, oh, this is a strategy, and wanted to follow along. So yeah, been great.
We're very happy to be partnered with you guys, and appreciate your support and for bringing me on with the podcast.
Absolutely. Take care. We'll talk soon. See you, Eric.
All right, guys.
Bye. See you, Eric. Thanks.
Bye.